go. Alright, we're going to be going through option spreads, what they are and how to use them. I'm just going to go over two basic ones for now, and I'll be able to answer some questions off of it. This will be debit spreads and credit spreads. In this particular instance, purchasing calls or puts and simultaneously selling calls or puts against that position in one position. So example would be we get QQQ, a June contract for we purchase 524 and we sell a June contract for 535. Um, we would use this if we expect the stock to go up to a certain value, such as over 535 by expiration or sooner. Um, uh, the reason is, hold on one second. Okay. You expect the stock to go to a certain value by expiration or sooner. Works like a call with low risk but also with capped gains. The best time to use debit spreads is when you expect the volatility in the market before expiration and to see a specific price target by expiration. In this example, we have the QQQ 525 535 spread, um, and you can see the you can see it. I don't know if you can see my mouse or not, maybe, but you can see that the value of the contract, uh, as long as it is above 535 by expiration, you will receive the full value of 843 up in the top right hand corner there. And you can kind of see how the spread works over time, just like as using it as a call. So right now, QQQ is trading at about 480, and this purchase price was for uh, it was when the market closed, which was about 482. So if we purchase at that value, the value of the debit spread was about $106 for the entire spread. And then you can kind of see how it works over time as the month of May and the month of June go by. You can see the total value that you would get for the different uh, values that QQQ may be at. And then as long as it is over 535 by expiration, that 843 will be for anything that is above 535. I should have made this a little bit larger for that particular instance, but it does cap your value at that $10 spread. And since we bought it only at $1, $10 minus a dollar is about $9. The total value being, 843 or whatever. Um, the uh, the maximum profit is received when the stock price is greater than the stock price or the strike price of the sold call. And like I was saying, it goes through. It'll be the spread of the 535 contract and 525. You're selling the 535 and receiving the premium for that, and then you're also purchasing the 525. It'll most likely be exercised by the buyer since the stock is above the strike price, because no one wants to lose out on any value. If QQQ is trading at, let's say, 540 or 545 by the time of expiration, the buyer of the call that you specifically sold will lose out on money if they let the contract expire. So they will most likely exercise that call so that they can receive the shares, and then that's like they basically purchased QQQ for 535, and then when the stock is at 545, they receive a value as well. So technically, both profit at this at whenever you sell calls. And since it's exercised by the buyer, then that means that transaction needs to be fulfilled somehow, and your brokerage will either purchase 100 shares on your behalf, or it'll exercise uh, the the long call that you have in order to fulfill that transaction. The brokerage is most likely going to use that long call that you have because they assume that you don't have the capital to purchase 100 shares. Um, and that's usually how most of these spreads work is specifically by this uh, this process of exercising the calls. All right. So uh, once the brokerage exercises the long call that you have, they're basically buying 100 shares for the long call, the strike price of the long call, which is 525, and then they're selling it for 535, which is the short call of the spread. And so since the brokerage is doing it on your behalf, it's not going to let you have, or it's going to, sorry, it's going to give you the cash difference from the transaction, which the total value will be $10 from the spread there. So if you had a purchase price of 106, um, and then you get that $10 value from the spread exercise, then your total profit from the entire spread that you purchased is going to be $894 for that specific spread. And that's going to be the max value. You can only get that when it's exercised, but the value of the two contracts will vary over time, like we saw in this example here. This is going to be the value of the two spreads basically combined. The long call is going to be worth more than the short call, obviously, and then you can close out both calls at the same time and receive the cash value of both, because obviously one's going to be more expensive than the other. You can still receive a gain, and it kind of works like a call in that case. Um, and then same thing with the you know down here in the red is it may be less value as or less than your purchase price, at least if it's under 106 dollars, like 482 for today, or like uh, if it's under 492 by May 20th, or if it's under uh, what is that, 500 by June 1st, for example. That's when it starts getting red, because it's under that 106 value that you purchased the contract at. Um, And yeah, basically it just works like a call in that sense. Credit spreads kind of work inversely to that. In this case, you are selling a call or a put that's closer in the money than the purchase call. Um, and you get a credit for the transaction based on the premium differences between the two contracts. So uh, if you sell one call that's going to be, uh, let's say like $100, and the other one's going to be 100, and the one that you purchase is going to be $50, then you're going to receive a $50 credit just because of the difference in the two premiums. And then that's going to be your max profit that you're going to get for the whole transaction. But then your risk is going to be um, the spread if the stock price goes over the purchase call, because then you're going to need to fulfill that transaction again, as the short call is not going to be it's most likely going to be exercised as long as the stock goes over that strike price. Uh, Works like a cover call in that you gain from the contract as theta reduces the value of the contract. So if you sell a call and then it goes down in value, you've already received the premium for that call. So then as the value drops over time, you just basically can buy back the contract for a lower price and then realize a gain on that, or you can hold it until expiration. And if both contracts expire, then you receive the full profit and don't have to worry about um, purchasing the shares to fulfill the short call. Best use for this is when you don't expect the stock to reach a certain price. It is best in low volatility as well to reduce the premium price. I use the same spread just as a credit spread, just to kind of show how it works. Um, you can lose the entire value as long as QQQ is over 535. Remember the debit spread, you gain the full value as long as QQQ was over 535. This is completely inverse. Um, and then since the short call is 525, you actually receive the entire value as long as it is under 525 by expiration. And then the total value of these two contracts is 106. So the most you're ever going to get from this specific spread is going to be 106. Um, Typically, I like to use these in shorter time frames, just because it's a little easier to manage, and you're not kind of trying to restrict the stock if, especially if it's a growth stock like QQQ, it's going to keep going upwards for, I mean, it could even get to, 600 in the next year or two. Um, the max profit is gained if the stock remains under the strike price of the short contract. So you receive that $106 premium credit value, and QQQ needs to remain under 525 by expiration to receive the full value. Alright, so this is kind of like a little example from ChatGPT as well. Debit spreads you pay the 106, credit spreads you receive the 106, and it just works inversely. Profit direction, the stock needs to move. It kind of works like a call in that sense, but it's a little bit easier and your risk is reduced. And the credit spread, you want the stock to stay within a certain price in order to gain the max value. And usually you get less with debit spreads and credit spreads than just getting calls outright, but it is a lot less risk, and that's usually the best way to do it. And it's really good for swings in particular, um, because then if there's any volatility, like you can see, QQQ goes all the way down to 400, for example, and then comes back up to 480 within a month. Um, that kind of price action would devastate calls if you were holding them for a long period of time, especially if they're out of the money. If they're in the money, then that'd be a different story. But with credit spreads or credit and debit spreads, these are going to be out of the money in order to keep it low risk. And there are some ways that you can use it in the money. It's just not as practical because you're already near the spread value as the closer that you are in the money, if that makes sense. So if you were to do like a spread of 475 to 485, it's already going to be within $10 if you were to open up a contract for almost any period of time. Just because it's already half in the money, it just doesn't work the same way. Um, in one of my previous PowerPoints, I went over covered calls. This kind of works in the same sense, just purchase at different times. So you can buy a long call and then you can sell a call against it, and then that basically turns it into a debit spread. Um, but when you sell the call against it, usually you wait until the stock price goes up already, so that you're gaining more premium value for the sold call to reduce costs and to kind of lock in some of the profit that you gained from the long call. And usually they're more shorter dated as well, just to kind of let it expire without actually exercising the long call, if that makes sense. Um, that is more of a calendar spread, um, and I can go over those more later. But this is kind of like the basic idea of how the spreads work. Um, is specifically, uh, hold on. Specifically, the exercising portion here is when you're buying a long call and then fulfilling that short call. That is the entire process of the spread, and that works the same way with like covered calls, for example. If covered calls go in the money, then by expiration, then you are assigned those shares, and in the same sense as the spread, your brokerage is basically going to purchase the shares in order to fulfill that short call, and it can either let you purchase 100 shares outright with all the cap if you have enough capital for it, or you can use the long call in order to fulfill that. Um, and it works the same way that way too. Um, I know this is a little bit confusing, but are there any questions?
Yeah, I have a question. So is this like a strangle?
Um, no, well, kind of, not really. The strangle would be if you purchase a call and purchase a put in this at the same time. Your risk is limited in that sense because um, uh, if you purchase a put, then the total value of the put could be reduced to zero as the stock price goes up. And then you gain infinite amount in an upwards direction as long as the stock keeps going up. And in the same sense, if you have a strangle and the stock goes down, the call is going to go down to zero, but then the put's going to gain infinitely as long as the stock goes down, if that makes sense. In this sense, with a spread, you're already defining the gain that you're going to get no matter what the stock does. So if the stock goes up and reaches the certain price, um, then you gain a certain amount, but you also risk a certain amount as well. Very little uh, compared to a strangle. Also, spreads are more directional as opposed to a strangle. Strangle expects a large move in either direction rather than a spread. Um, you can utilize uh, you can utilize call debit spreads for a bullish move, and you can do call credit spreads for a bearish move. Um, and then you can do put debit spreads in order for a bearish move, and then a put credit spread for a bullish move, if that makes sense. But they are
Yeah, so so when you sorry, when you mentioned, right, the basically how do you lose with debit spreads? You only lose if you go against the trend, right?
uh, yes, you can lose if you go against the trend and the stock doesn't reach the price that you're looking for. So if QQQ doesn't go over 535 by expiration, then the entire spread could be reduced to zero by that period of time. If it's between the spread, then as long as it is over your purchase price, you'll gain value that way, like we saw with the chart here. Let me. Oh no. Hold on. Let me.
So earlier you did a spread for QQQ, right, on your channel. That was a oh,
Uh,
debit spread. I see.
debit
Okay,
spread.
so
Yeah.
475. Okay.
So as long as it is above the purchase price, which is 106, you can close it out at any point in time until the expiration, and it kind of works like a call in that way. Um, but since we bought it for 106, um, the entire spread can actually be green as long as it stays above $1.06 above 525, if that makes sense. So 526 and 6 cents, you'll be at break even by expiration, if that makes sense. So as long as it's above that, you can still make some profit off of it, and then you gain the full value if it's over 535 by expiration.
Thank you.
No problem. One thing I get confused about is getting assigned. What does that happen if you want to avoid it? What do you do? Um, you can close out the calls in order to risk or to avoid getting assigned, or you can roll into another contract, which is basically closing out that contract and simultaneously purchasing another one at a different time or a different value. Um, if you expect the stock price to keep going up, it's good to roll it into a higher. Uh, if you're doing covered calls, it's good to roll into a higher contract value because then you're gaining more if it does get exercised, but at the same time you're also uh, reducing the chance that it would get assigned, and then you just gain the premium value from it, if that makes sense. Is there an example that you want uh, to maybe use that for? Okay. In my particular example from well, actually, let me see if I can bring it up. Give me 1 second here. Okay, so in this particular example, I had either 100 shares or a 2-year leap for NVIDIA. $90 for January 2027 was only $4,000. Um, if I didn't want this to get assigned, or no. I want to sell covered calls against it. Let me see if I can find where that went. Here we go. So if I want to sell an $8 contract, let's say Nvidia, you have a strike price of 90. You purchased it when the stock was at 110, so you paid only $4,000 for it. If Nvidia were to jump up to 130, then the you would probably want to sell a covered call that is out of the money, maybe let's say like 160 or 170. Um, yeah, here. Sell 30-day to 90-day covered calls for a strike price of 170 for $800. You want to wait until it gets to 150 because for Nvidia specifically, that's a point of resistance that it has not been able to get through very well over the last. I mean, that's its all-time highs almost as 153. So if you sell a covered call for 170, it's very likely that it's probably not going to hit that specific strike price by the time of expiration. So you're receiving that $800 in premium just for holding that contract and letting it expire on its own. Um, if you wanted it to get assigned, then you would probably sell something that was close to $150 or close to the current um, value, or maybe even less. You could sell a contract for 130, and the value of the contract is going to have an intrinsic value that'll keep your break even near what the current NVIDIA trading value is. So if it's 150 at the time, 130 call is going to be at minimum a $20 contract, and uh, you can. Oop, I didn't mean to do that. If you want to, if you want to sell the shares or you don't mind selling the shares, it is good to hit a point of resistance and then sell a covered call that is in the money for more premium. And it kind of mimics selling the shares and getting rid of the position. But then you also receive a little extra premium just for being out of the with just for having a little extrinsic value, which is more than the $20. So let's say you get something that's 30 days out, and you can sell the covered call for $20 in the money, but you can also sell it for an extra, let's say, $400 or $800 on top of that that's out of the money, just based on the extrinsic value and that's affected by theta. So you can sell 130 covered call for let's say $28 instead of $20 in that case. And then Nvidia decides to go down. Uh, let's say Nvidia goes down to 110, and then by expiration, the entire contract that you purchased is now worthless, or not purchased. The one that you sold is now worthless, and then you receive all the value, the entire $2,800 from that contract, and you're still holding the long position that you purchased for the 2-year leap or 100 shares. And then you also reduce. You didn't get assigned either because it expired by the expiration, or it expired uh, out of the money. All right, no worries. Is there anything else you guys want to see, or anything else I can go over that can try to help out with this? So what stocks would spreads be better than? Oh, stocks would be better than covered calls. So well, for my specific example, that was based on the calendar spreads. This is uh, an optimized calendar spread strategy, um, and uh, in this case, we're buying uh, a long-term contract that is in the money, or you can buy 100 shares as the long-term position, and then you would sell covered calls against it as the second half of the spread, if that makes sense. So if you were to buy $90 strike for Nvidia, then the spread that you create is $90 or sorry, um, if you were to purchase a $90 strike price call and then sell a call against it whenever it goes up to 130, you're creating a spread of 130 minus 90, which is 40. That's a $40 spread that you're making by selling that covered call at a separate time. Um, and then same thing with 100 shares. If you buy 100 shares at let's say 110, then you're making a synthetic covered call by selling a contract against those 100 shares. So the long call or the shares that's going to be fulfilled by the covered call um, is it's basically like buying QQQ at 525, for example. You can buy 100 shares of 525, um, or you can buy a 2-year leap for 525 and then uh, sell the 535 against it as part of a spread, if that makes sense. Um, Particularly for covered calls in this example that I had here for this PowerPoint, this is um, for the calendar spread. The reason I want to do this is because I want the short call to expire so that I can gain value on the long-term position over time. So if I hold on to a position for 2 years, then I can sell covered calls for $800 every couple months or so, and then I can reduce my cost basis, and then um, I can also gain money over time just by holding the long position, not including the gain from the long position itself, if that makes sense. Yeah, here. Every 3 months, you sell covered calls for $6 to $8 profit. If you were to buy shares, that brings your cost down from, let's say, 110 down to 102 to 96 to 88, and it would take you um, 42 months to bring the entire cost of that position down to zero. And then same thing with a 2-year leap. Um, you do the same thing. Your initial cost is $40 contracts, and then you sell $68 contracts against it every 3 months, let's say. It brings your cost down from 40 to 32 to 24 to 16, and it would only take you about 15 months or 1.25 years to bring that cost down to zero. And then at that point, you can keep on doing it, and you're still making money even while you're holding a long position that gains value over time. So a $90 strike price and let's say Nvidia goes up to $200 in the next 2 years, well, that alone is going to be a $110 gain just by holding a long position, not including the covered calls that you're doing here. So you're just making extra money by doing this process. When would you choose either? So for the spreads that I was talking about, I would use them uh, like a less risky um, uh, call position. Um, because it
I
would.
just got paid.
Ooh, I just got paid too. um, if you'd use the spreads, you can use them as a swing trade. Just it kind of uses it like a call, like I was saying. If I go back to my other slide, best time to use it is when you expect volatility in the market before expiration, and looking for a specific price target. Um, and if I want to swing trade, uh, you know, QQQ 525 to 535, I expect that QQQ is going to hit 535 by the time of expiration, and then I would be able to gain from the 106 to a total of 894, or by expiration in that case. And then you can do this with puts as well if you're bearish. It'll work exactly the same way, just as a put basically, less risky. But other than that, if there's no other questions, I am finished with this.